The market is in two minds, and you can see this split in the headlines, and it also explains why stocks are up one day, down another day, up another day, down, up, down, up, down, up, down, up, down, up, down. And I know it's driving everyone just crazy, right? Crazy. So what's the deal? What's the deal? Like, why is this going on? And I know you'll be like, hey, how long is this going to go on? So the most simple way is that the market is split between two different mindsets. One set of investors are really, 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 really focused on inflation. And they look at oil prices, they look at rent, and they look at food prices, and they're like, oh my God, it's the 1970s. We're going to have stagflation. We're going to be in lines for gas. We're going to be in lines to get food. And we're going to have a huge, huge crisis where the store shelves are empty. There's going to be no gas at the gas stations. And is just going to be a replay of that horrific period in the 1970s. So then there's the other side, which you can see in headlines today, which is that new home sales, in other words, the sales of homes that are made brand new versus, when somebody moves out and resells their house, that was down by 16%. 16%. I mean, this is a big, big number. And if you were paying attention earlier last week, you had stock prices of Target go down by 25%, Walmart go down by 15-20%, Ross stores go down by 15%, Costco, while they all reported that their inventories, in other words, what they're keeping in the back room to sell, they are soaring. Like there's like crazy amounts of unsold stuff. And this is while they're cutting prices. So while their sales look good, because they're still reporting increasing sales, what they're saying is that we have too much stuff. We have too much stuff. And that's for two reasons. A, people are buying a little bit less. And then they're buying something completely different than what we have. So people are looking at that and saying, that's a recession. People are not spending. That's a recession. So we've got these two narratives that are kind of like playing. And every day there's this dance that's going on between inflation, recession, inflation, recession, inflation, recession. And if you want to track what's going on, then you would look and, see, which is that when the inflation sort of fear mindset is taking over, then you would see bond prices going down because inflation means that the future value of money is less than it is today. In other words, there's too much money, not enough stuff. So, when you go take your money to buy something in the future, it's not going to be worth as much. You just buy a lot less. The recession scenario is the opposite, because in a recession, what do people do? They stop spending and they start saving. And in that scenario, companies start to cut back. They will start to lay people off. They will start to buy less. People start to buy less, save more. And now you have what is called recession. In other words, people just stop doing the stuff that they usually do. And we do that kind of stuff at businesses. I mean, when you go shopping, when you go to a restaurant, when you go to a movie, when you get on a plane, when you go to anybody's business, what you're doing is taking your money and spending it. And if you stop doing it, well, the person that's running that business, they don't make any money. And if they stop making money, then they're going to have to cut people off. They stop buying stuff from their suppliers, whoever they count on. And as that chain reaction keeps going, well, now you have a recession. In other words, where essentially everybody's stopping spending. Now, what would happen in a recession is that the Federal Reserve would cut interest rates to try and stimulate people, businesses, everyone to stop saving and to start spending more. And so you can see how this inflation recession dynamic just keeps sort of like bouncing markets around. And then there's another wrinkle for our stocks, which is that the inflation folks, they think that inflation can go much higher and is going to keep going for many, many, many years. They're thinking about like 5, 7, 10 years. Remember, they're thinking this is like the 1970s. And so the folks that believe that, they're like, well, if you're a company that is still in the process of investing back in your business because there's huge opportunity in front of you, well, those profits, when they come, they're not going to be worth as much. So, of course, our stocks, growth stocks, Fourth Industrial Revolution stocks, America 2.0 stocks, well, they're all crap. And so what you want is to buy into companies like Target, like Walmart, like Home Depot that are piling up inventory, whose sales, while being okay, they're slow. I mean, they're like, 1, 2, 3% barely. And that's with very high prices. So if you stripped away the impact of inflation, they would probably have negative sales growth. So you can see that there is like all of this back and forth going on. Meanwhile, our companies are growing at 15 or 20 or 30%. Yeah, they don't make profits, but that's a choice on their part to reinvest back in their business. Because if you have a business that's going at 15 or 20 or 30%, if you were a private business, you would reinvest all of your profits back into the business. You wouldn't look to simply show that profit, just for the sake of it and walk away from your opportunity. So bottom line, what's the point of this video? Well, there is a lot going on out there. There are a lot of trends and counter trends. And what we believe is going to unfold is as follows, which is that over the next 3-6 months, some things are going to happen. This is my bet, right? And this is what I believe will unfold. One, the Federal Reserve seeing the recession case starting to really start to take hold, which is that sales at Target, Walmart, Home Depot, Ross stores, Costco, seeing all of that, seeing housing going down, spending as a result starting to go down, starts to see that a recession is starting to become much, much more likely. And then as this recession mindset also starts to enter financial markets where people are unwilling to lend to each other because everybody wants to be safe and wants to be in cash where there's no risk, there's no liquidity in the markets. And so if you're a business and you need funding from the markets, nobody's willing to give it to you. That's a problem that has, a word, it's called contagion. In other words, that spreads from market to market. And the Fed seeing that will have no choice but to say, you know what, we can't really keep going there. And I think inflation is going to bail them out because if housing prices are going down, well, consumer spending is going down. And we already know that consumer spending is going down because of Target and Walmart and Home Depot and others. It's going down. And if housing sales are going down, well, it does mean that housing prices, at least for some short-term period, have likely peaked. Rent prices have peaked, and they're also going to fall off. So we think that all this chaos is actually going to resolve itself where inflation will actually start to show that it's peaked, and the recession will show that it is going to need some attention. In other words, they are going to need lower rates to keep things going. And these things are going to marry each other. And that's going to be great for our stocks because they have suffered really as a result of both of these ideas, which is that inflation has meant that people have priced in interest rates going up for the next 1 year. And if inflation has peaked and is going to go down, we are not going to see interest rates go up for a very long period of time. I would say that at best, the Federal Reserve will likely get one more rate increase in come June. I would say there's a 50-50 shot of them getting one more in July. And then I believe the recession case will be now so significant that they will not be able to do any more. And they will need to stop and potentially even start to have to reverse and go in the other direction. So you might be thinking, well, Paul, well, that sounds all reasonable and nice, but you've said a lot of things, and hey, I'll say absolutely. But listen, the data changes all the time, and I can say that this has definitely been one of the most chaotic periods in 30 years, where there's so many mixed signals going on in all kinds of ways, while there is this extraordinary opportunity of disruption and digitization, fourth industrial revolution in front of us, that really argues for a very long-term time horizon because the gains can be so large. Nonetheless, I'm sympathetic to the fact that, hey, our portfolios are down big, and people want, you want to have some sense of where things might be. So many of you may be thinking, well, Paul, then, we should sell and wait, and buy back in 2 months. And remember, markets are always forward-looking. They anticipate. And if I'm telling you all of this, I can tell you that other people on Wall Street are seeing the same things, which is why if you track bonds, you will see that U.S. government bonds are starting to go up. In other words, people are starting to worry less about inflation and more about recession. There's a mini breakout in all the bond ETFs that I track. The ticker symbols are TLT for the 20-plus year, IEF for the 10-year, SHY for the 1 to 3 years, and they're all starting to go up. So that is telling you that people are betting with money on inflation having peaked because they're buying bonds. Remember, you don't want to buy bonds during the inflationary period because you're getting your money back much, much later and you're getting less. So most people don't want to own bonds if inflation is going to keep rising. So people are starting to bet with actual real money that, hey, inflation has peaked and the Federal Reserve is going to have to stop. And the same thing you can also kind of beginning to see as well in our stocks, where while there are still stocks making new 52-week lows, there are fewer and fewer making them 52-week lows. And it's starting to be where you can also see that many stocks have bottomed and they're holding on to at least the gains from the absolute bottom. Now, there's obviously, big headlines about Snapchat and others that are out there. Nonetheless, a lot of stocks, they've hit their 52-week lows. And the moment that they see that the Federal Reserve is going to switch, now the entire perspective of how people look at markets is going to change. People are going to go from safety to wanting growth. And why? That's because if recession is the issue and the Federal Reserve is responding to that and inflation is no longer the issue, then growth becomes the issue. And growth becomes the scarcest thing, the thing that is going to be valued at a premium. And that's what we own. That's what we own. We own companies that have sustainable growth of minimum 10, 15, 20, 25, 30%, some even 50%. That are out there. And these companies will be valued at sky high levels, meaning that there will be a huge, huge, massive move up. In my Profits Unlimited update today, I said that, hey, I believe, and I've been given hell on Twitter for saying this, that we would see our stocks recover this time next year. In other words, even from the high prices that we paid at the end of 2021 and early 2022, we would see a massive recovery. And the reason for this is threefold. One, our companies are still growing. Second, they have been destroyed in price, right? Where people have presumed that the environment was going to be hostile, at least in the stock market, for these companies in terms of being valued. And that is going to be untrue because with the recession case taking hold, interest rates no longer rising. In fact, where there's a scenario where it actually starts to go in the reverse direction, now growth will be valued at a premium, a recovery for our stocks. And I also said in the Profits Unlimited update that I can expect to see gains, even from the high prices that we paid at the end of 2021 and early 2022, the 1 to 3 year time frame. So that's what is going on, in my opinion, in my judgment, from my perspective. Remember, this channel is opinion, not advice. We're not financial advisors. We simply take our understanding, our knowledge, take the facts, and try to do the best that we can. And that's what, I see unfolding for the rest of 2022 and then into 2023. So if you like this video, give us a thumbs up, subscribe, come back next week. Until then, this is Paul saying bye.